All right, guys. Well, I guess we'll get started. Thanks for coming. We had to change our venue because of the storm. Next one we'll have at the Golf Performance Center. It's a really cool space. And if you're into golf, it's even more cool because they got a lot of technology down there. Today, this is much better with the rain. So thank you for coming. We'll introduce ourselves and then we'll talk about this investment opportunity and then have plenty of time for questions and any comments. And feel free to raise your hand for Evan and he can bring you whatever you want to drink. And we'll just go from there. All right. So Bethany, why don't you go first?
Hey there, I'm Bethany Roberts. I'm from Chevy Chase, Maryland. My husband and I moved to Wilmington last year. I graduated from Sewanee, the University of the South, if you're not familiar. And I've had 6 years of nonprofit fundraising experience prior to transitioning to real estate full-time. My background in real estate is residential and now including multifamily investments under Ashley. It's nice to meet you. Thank you.
Everybody, I'm Michael Crocefoglia. It's nice to meet you all or re-meet some of you from a couple of our last meetings. I've been in real estate since 2019. I own a portfolio of about 30 units myself up in Pennsylvania. Moved down to Wilmington about a year and a half ago. Met Ashley here about a year ago where we first started working together at Intercoastal. Helped him out on the Gastonia deal as well. And really excited to be able to share some more info with Renmar Village on you guys. Thanks.
And so I know almost all of you, but my name's Ashley Garner. Most of you probably know that I sell residential real estate, and that's have done that in Wilmington for almost 20 years. And I have a small team of people that work for me, and we still do that. My personal passion is this. I grew up in the rental real estate business. Literally, my dad started with student rental housing when I was in high school. So I actually, worked on the plumbing and installed the vinyl siding and did all that. And then the leasing and the legal and the finance. And so that's my true background. I started building my own portfolio of rentals here in Wilmington, probably in like 2010-ish. And so I still have one 10-unit place downtown Wilmington and a 32-unit property at Campbell University in Lillington and the 37-unit property that Michael mentioned in Gastonia. It's called Davis Mills, and some of you are involved in that. It's going very well, right on track. That closed back in December of this past year. So less than a year, we're less than a year into it. So the whole reason that I do this, by the way, is that it's important to me not to feel trapped in having to trade my time for money. And so, I thought, well, I'll be a real estate broker and I can be my own boss. But I quickly realized that you're still trading your time for money. If I didn't take a shower, put on my bow tie and go show houses, I didn't get paid. And it's not that I don't like work. I just don't like that if you stop working, you stop getting paid. So it's like, there's got to be more to it than just doing this and then it's over. So I've always been a big believer in this, like passive income. If I don't go to clock in, that I still get paid. And I think that's important. It was important to me for my own self, and it was important to me for my family and to leave something as I went on and did other things like that. Whether I was here or not, there was still something to continue. So that's the reason that I do this. My goal is not to create some big monster that I've got to feed and do a bunch of transactions just to get fees enough to make the payroll. That's not, I'm a real estate investor and I'm here to make passive income. So when I analyze deals like this, it's from that perspective. And as opposed to, I think this is good enough that I can get it closed and collect my fee and then move on. It's different. So to me, I want something that pays me a very good return so that I can reach my goal of that financial freedom or financial independence, that I don't have to trade my time for money. So I think that's important to know, because there are other people that have different goals, which is fine. That's just not mine. Okay. So as a good setup, by the way, so keep that in mind when we go into this and realize that between Michael and me, we have analyzed hundreds of these properties. we have, worn our keyboard out running spreadsheets, and most of them make it to about the first page and then we're out. And in fact, most of them we can tell before we even put it in the spreadsheet whether it's going to work or not. We know the numbers that well. And so this one was on the market. It didn't work. We analyzed it. It didn't work enough for us to pursue it. Then it went off the market for a little while, came back on. Some things were different, so we dug back in, and we're like, yeah, I think this one might work. So we just kept going, and that's kind of my philosophy is I'll keep going one step at a time. If it clears this hurdle, I'll keep going. And so this one cleared all the hurdles to the point that we decided to make an offer. We made an offer. We were then in a multiple offer situation. I think there were probably 10 or 15 total offers. We got down to the best and final round, which was pretty exciting. And that was us and I think 3 others. It got down really then to us and 1 other. And we had our call with the seller. The seller of this property is Monument Capital, which is Alex Rodriguez, the baseball player. That's his deal out of Miami. And so they're a huge outfit. I was not on the phone with Alex Rodriguez, although I did ask if I could speak with him.
Not yet, not yet.
They said, yeah, maybe your next deal. But I was on the phone with people who have been in this business for decades. And we were competing against, I think, probably other larger firms and outfits than we are. And so they have the buyer interview call. And so they're on the phone with me. It's the brokers, 2 representatives of the owner, and me. And they just basically grilled me for 20 minutes on how you think you can pull this off. What type of numbers did you use in your underwriting, et cetera, et cetera. Their biggest concern was, could I raise the capital to close the deal? 7.7 million is a lot of money. They knew that this was my largest deal to date, and so they really kind of hammered me on that. And evidently, I answered the questions to their likings. I was very candid and sincere, and they awarded us the deal. So here we are, and we're very excited. It's a great opportunity. It's a great. It's not sexy. It's safe. I'll give you an example. So it's our year 1 pro forma. So the first year after we take ownership, it's already doing what we project it to do in that year. Like we don't even have to do anything, and it meets our criteria. So from then on, and now that's average rents, current rents, including their current vacancies, including the rents that are on the rent roll that are too low. So they're currently signing leases at rates that are higher than we have projected in year 1 and mostly year 2 and into year 3. So we just have to continue this process. This is not a reposition. This is not a CapEx deal where we're going in and making all the units platinum with granite and, wood floors. That's not this deal. This deal is buy it, manage it efficiently. There are a few things, CapEx things that we're going to fix up. My wife laughs because she's like, you love a parking lot. And I love to like seal and stripe a parking lot because it just makes it look so nice. So we'll probably do that. Some gutters, some landscaping, add some uplighting, some like pride of ownership things for the tenants. That's the plan. And then continue on to just organically grow the rents. It works as it is. And with these little tweaks, then it's going to work really, really well. I guess I'll take you through a few of the slides. It's going to prompt me to remember. There's lots of stuff I want to tell you, but I don't want to get you glazed over. Go
Real
ahead, Mike.
quick, just on the competitive bid process, I think it's important to note that we didn't budge very far off our initial offer. We won this deal off of the business plan that we presented to these guys, that they bought into, the fact that we could do what we say we're gonna do,
Yeah.
and that we're not taking leaps and bounds to make the returns happen. So I think it's really important to know that, like, other people might be promising the moon. We're promising what we think we can achieve, and we think we're gonna hit it.
Yeah. One other note on that, they grilled me on, why is your CapEx budget so low? Because your competition is not that way. You know, they all have a big stack that they're planning to put in to dress this thing up. My answer was that I don't think, number one, it doesn't need it, as I just explained to you. Number two, this economy is not, it's not the time to do that. You can't, like, our rents right now, in some cases are flat. I see concessions coming back into the market, people giving away months rent free or half a month rent free to get tenants in the door. It's not the time to do that. The people that live in these apartments, I think they're feeling the inflation. Their wages aren't going up as fast as the stuff that they buy is going up. And so to pay the cost of getting $2 million to fix this place up to like Taj Mahal status, you can't get the return out of the rent right now that you need to pay you guys back your money. So I think it's not the right time. I think in 3 years, 3 to 5 years, it's going to be the right time. And I think by then we'll just probably sell it and move on. What I mean is that there's new inventory being delivered to the market right now, which is leading to some of this, you're not able to raise the rents and concessions. Those things are going to be absorbed in the next year or two. And then there's nothing new coming, especially in Jacksonville. I don't have the slide, but I do have the construction development pipeline in Jacksonville, and it's hardly anything. It's like, what, 6 things?
We had 1 slide for Jacksonville and
Yeah.
6 for Wilmington.
Yeah, we have the development pipeline for Wilmington. There were 6 slides worth. In Jacksonville, there was 1, and there were like
Might have been 6 properties.
maybe 6.
Yep.
So the competition's not a problem there. It's going to be absorbed. And then what's going to happen is the demand still goes up and the prices go up. So anyway, I'm going to go through this. Y'all got this via email, but there's some things I want to highlight that are maybe be potential questions or you may want to know more about. So we are the sponsor or the manager or the GP. Those are all like lingo terms that they call us. Okay. So us, the GP owns 20% of this deal. 80% of it will be owned by limited partner investors. Class A shares, our shares are called Class B. So how do we make money? So we make money, these 3 fees. Acquisition fee is 2% of the purchase price. That's a kind of standard across this industry. I mean, just like our real estate listing commissions, nothing's set in stone. Everything is negotiable. It's kind of what's fair, it's market driven, et cetera. The asset management fee is 1.5% of gross rents. So think about every month, whatever we collect in rent, a fee comes to us of 1.5%. And then a capital transaction fee is 1% of the sales price or refinance amount. Obviously, the reason for all that is there's a lot of work that goes into all of these things. So that's where the fees come from. And I mentioned to you before, like, our business model is not to just crank these things out to collect these fees. Some do, and it's a fine business model, but that's not ours. And then here's the 80 and the 20. So the SEC attorneys, by the way, this is called a syndication, and it's a security, right? So the SEC governs how we handle this. And so there's some rule exemptions, and like 506B is this one, but the SEC attorney is very particular about how we word this stuff. And those fees were in there, but they weren't in there big enough. They wanted them like in your face. This is what we're getting paid, and it's just so everybody knows. So there it is. Deal at a glance. So we're attempting to raise 7.7 million roughly. The projected annual return. So these are all projections, and there's some reasons that these are changing to the good that we'll touch on here in a minute. Projected average annual return, 19+%. That means that on a 5-year hold, all of the money that you get in the total of the 5 years, and then you divide it by 5. That's the average annual return. Cash on cash return. So this is the average over the cash payouts that we're giving every year. So this is a cash flow deal. We don't have to like develop it, build it. We don't have to wait to do stuff. We anticipate paying out cash flows beginning in the first year. It may not be the first quarter, it may not be the second quarter, but in the first year, we will be paying out cash flows. That's the intent. And then every year from then on, in addition to when we sell it at the end of 5 years, then you get your share of the sale proceeds, whatever the net proceeds of the sale, then you have your, whatever you own, you get your percentage of that, okay? Projected duration is a 5-year projected hold. Now, someone asked me today, well, what happens if the market's not right and, you know, are you just going to sell it anyway? Like, well, that's yet to be determined. So the buy-sell decision, as spelled out in the operating agreement, is the decision of the general partner. So, in other words, we don't come back in here and we vote, should we sell it or not? It's like our decision, unless we do something wrong and y'all outvote us, which is in the operating agreement, by the way. There's a way to get rid of us if we do the wrong thing.
If we're that bad.
Yeah, if we're that bad. But the point is, if we have the option, maybe we don't sell it, maybe we refinance the debt and keep it. Maybe the market's so good and the rates are so low that we do a cash out refinance, give you your money back, keep it, and then just keep going with infinite returns. It's possible. I've got 3 properties that I've done that with, and it's like the ultimate jackpot. Or, you know, maybe worst case scenario, we just sell it, break even, give you your money back. So that's, you just have, you know, no one knows what's going to happen in 5 years, but we just use our, you know, the same criteria we did when we bought this. We're all in this together and we all want to make money. So that's the perspective we would use. We project that we will pay out quarterly, and it's 196 units built in 1973. I already told you about the business plan, which we don't have to do the CapEx. The financing. So this is exciting. So today, so we did our underwriting and we used 5.91% for the underwriting. Hey, Jane, there's a seat over there by Sarah. So we used 5.91% as a Freddie Mac loan, and we did our underwriting. So all of the numbers that y'all have seen, including these right here, the 19 and the 6.5, those are all based on 5.91%. So if you follow this kind of thing, the Treasury, the 10-year Treasury has dropped off a cliff since then in the past like week. And that's what this loan is based on. So Freddie Mac, they did increase the spread, which was kind of crappy, I thought, but I kind of knew they were going to do it. Long story short, we have to sign the application for the loan by Friday, and we will reserve our 5.37% interest rate, which on a $15 million loan is a big deal. And it changes these numbers. Now, the reason I didn't change my slide, in addition to the fact that it takes too long to get the graphics department to do it, the main reason is it's not locked in yet. So I don't want to, last thing I want to do is promise you something that we can't do. I would rather tell you this, and really in the back of my mind, I know it's about 22, but we'll get to that point later. So that's exciting. And then we were just at luck of the, like, right place, right time. It could have gone the other way, but we'll take it. We already told you about passive and all in the business plan. So this, you'll never see this, but any of you who want to know more about this stuff, let me know and I'll sit with you and have coffee. We'll go over it. I'll show you every number. This is that 5-year pro forma. And, you know, we're projected to sell it here in this year. So the average cash on cash returns are down here, and you see that they go up throughout, and that's how it creates the average. These rents, we even verified them today so that we have the confidence to stand up here and tell you this. That average that I told you, this is it. And we verified it again to make sure that we're not saying we've got to do something crazy or expect any kind of increase in gross rents to make our number. We did make two changes to so all these expenses are actuals, we got them right off of their financial statements. The two changes we made, one is to insurance and one is to payroll. So the insurance they had in at $1,392 per unit. We lowered it to $1,300 per unit. So not much, but a little bit. We think, I'll be interested to know what Peter thinks about this, but from our feedback from insurance people quoting it, that we can do what we hope is a lot better even than that. But we did lower that a little bit. Payroll, we lowered, I think they had it in some 353 or something. We lowered it to 294. They've got 5 people on staff, which is way too many. It's at least two too many people, too many full-time people. So we know we can do better on payroll. We think we can do better than even that. Everything else is right off of their statements. The first year will be interest only. So principal, we're paying 0 principal down in the first year, but that helps our cash flow out in the first year. It helps, it helps get everything in the system. It kind of makes it easier going in. So that's what that is. Then we start with the distributions. And so you see the asset management fee paid to the sponsor, 1.5%. And then everything after all of those expenses and the asset management fee is split on an 80-20 basis. So $464,000 is projected to be paid out in the first 12 months. Then there's your capital account, and that carries forward an average cash on cash. So that's basically the format of this report. And again, I'm happy to share it with anybody in detail so you can see it.
Reduction of the payroll.
Yep.
You're keeping the necessary folks at a good, you're paying them well.
Oh yeah. We're not, yes, that's important. We just don't, it doesn't take that many people. I think. No. We just don't need that many. I think there's some redundancy there. And I think the previous owner even inherited employees from the previous owner. So I don't know. We're going up there on Monday and we get to meet all these people. Our property manager is going to interview them. And really, with our oversight, we're leaving that decision up to her. Just because she's going to have to manage them. But we're all on the same page about what our goal is. And it is not to take advantage of them for sure.
I see.
Yes, for sure.
And then just really quick on the occupancy topic. So when we started underwriting this deal, the economic occupancy of the property was around 94%, which is already strong. Today, it's already at 96.5. By the time we take it over, with the new leases going into effect, it should be at 97%. So really strong occupancy. And the way we underwrote it, these figures, these numbers are all based on that 94%. So there's automatic upside built into the equation.
Also in the industry, that's a sign. I kind of like being full because it helps me sleep at night, but that's a sign that rents are on the high, that they're
The low side.
You've got room to raise your rents. If your occupancy gets up that high, it tells you that you can push it a little bit on the rates. Again, I always like when I look at I have no vacancies, but then I know, like, come on, Ash, you could probably do a little better. So
Making a comment, I don't know who in here is familiar with this, with investing in real estate, but I just learned something the first time at my age. You probably did this, I did not. But if you look at different asset classes and residential and commercial and multifamily, do you know that rents are the only thing that always is on the rise? There's never been a dip in rents.
I only know because you told me on the phone the other day, but I didn't know that before that. That's, I did not pay him to do, I did not pay him to say.
He's not planted. He's not planted back there.
It just is what it is.
Rents are not.
right.
And I never knew that rents were always on sort of the
Ashley, do you have any comments on the turnover?
Yeah, so the turnover is a little bit higher here than what we would see in some of the other places that we own. I don't know how it reflects on industry standard, but we think that that's probably because of the military component. Yeah. And so it does cost money to turn things over. That's the downside. Anytime someone moves out, you normally have paint, carpet, things like that. So it's far more expensive to have someone move out than it is to keep them most of the time. So it's just something that we have to manage through. We're well aware of it.
And when you look at the goal of trying to get the rents over 3 years to about that 1350 average, that turnover, that increased turnover actually helps us do that.
Yeah.
By turning over more units per year.
And keep in mind that I grew up in the student housing business, which is it's like the definite turnover every year, and it's expensive. So what normally happened was that we charged more rent to make up for that. And so and the market supported that. There are some leases at this property that are short-term or less than 12 months, and they're getting a premium for that. So that's what happens. It offsets the expense because you charge more money, but it's definitely a management thing.
And it's less than a dozen short-term leases.
Yeah. Good question.
What's the average rent in Jacksonville?
It's between 1,000 and 1,400, roughly. I was reading an article that the article, I'm not going to quote it, but it indicated that, and the article was about the housing shortage, a well-documented housing shortage in Onslow County, which is to our benefit, I think. This is workforce housing. This is not, Class A downtown Charlotte stuff. And the cost of owning a home is still way, 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 way more than paying rent, even though rents are up. And so it's unfortunate. That's the way it is. We're here, this fills a need. The tenants in here are families. I had my wife and my wife's right there, but I had my wife and daughter in the truck, and we were on the way home from dropping my son at camp, and said, guess what? We get to go see an apartment. And they're like, oh, no. I said, it's not very long out of the way. So we drove through, and they both made the comment like, oh, this is actually pretty nice. So my wife is normally like, get out of here now. Like, she doesn't want me driving through some of the places that we drive through to look at. She was fine with it. Annalise, my daughter, said, Daddy, this one's actually kind of nice. So, and she's 12. So she noticed. We felt comfortable there. It's just a good, normal America, heart of the demographic place to live.
And when you look at the entry-level BAH rates from Camp Lejeune, which is like their housing stipend, the lowest entry level for an enlisted Marine with dependents is at $13.95. So that's the very lowest.
Housing allowance, you got
Yeah.
B5 housing allowance.
Yep.
That's right.
And the increase over the last 5 years is about 12%. So it started 5 years ago at around $12.50. It's at $13.95 today. In 5 years' time, that puts us, if we follow that trend line, to about $15.60.
Yeah, what percentage of folks are in the military?
We've been told it's 70%.
70%.
Yeah, we're in the middle of a lease audit right now. And so we're going to find out a lot of those details, but that's what we've been told.
Just back on the turnover.
Yep.
Point. So how do you guys handle transition costs? Did they just do traditional security deposits or insurance? How do you guys do that?
Yeah, just traditional. I mean, historically, it's always just been traditional security deposits for damage and anything like that. We say it's not for rent, like this isn't your last month's rent. You still have to pay your rent. Sometimes they run out and we have to keep it and do the best we can. Then we always end up going to court for the judgment. Sometimes we get paid on it, sometimes we don't.
That's how their leases are set up.
Yeah. Yeah, they use a standard National Apartment Association lease. I don't know that we'll use that going forward, but it'll be something along those lines.
Turnover go faster than the judge.
Well, so our property manager happens to be named Allison, which is my wife's name, but she quickly said, that was the first thing she said, because they have a satellite office in Fayetteville and they manage properties there. Obviously high military, but she said, that's fine. She said, I call their CO and we get the rent collected. So if I can't get it from them, I call who's in charge of them. And she said, magically they pay it. So like, that's fine. That's good.
In your lease agreement, what's the annual increase?
Well, in this one, so it's 2% after here. And normally it would be like a standard spreadsheet would be like a normal 2% increase, like a cost of living increase or something like that. We've got a bigger jump here because we know we can get to we think we can get to this number here, but we're spreading it out just to be conservative. But what's written into the lease is just whatever the market will give us at the time. Like if we can get 2%, we'll get it. If we can get more, we'll get that. Right now they're getting more than 2%.
And right now, like if you look at the rent comps for this property and comparable properties, there's like a $200 gap per unit right now that we need to close over the next 3 years. And that's what our business plan is centered around, those first 3 years.
You should see Michael's spreadsheets. He's got the delta to average and the, like all this stuff. And I'll be writing. So here's see, I have these little books and I'm like, it'd be so cool if we had this number. And before I turn around, he's like, well, here, look at this. I'm like, how did you even do that? It's pretty cool. This one is another one that you'll never see from your seat, but this is the projected member returns example. So this example shows an investment of $250,000. And then it goes down and it shows, all right, well, that 250 will get you 3.2% over ownership of the overall thing. And then it goes down to break down your cash flows, the average return on the cash flows, et cetera. And then there's your capital balance. And so you carry that capital balance up each year. You got your cash flows each year. And then you see in year 5 when we go to sell. And so in year 5, you get your cash flow, your normal payouts, and then you get your percentage, your percentage of the sale proceeds on this line. And then of course you get your 250 back. So you come over here and that 275 is actually, you've already gotten your 250 back. So you get 275 on top of the 250 that you put in. So people, like you hear if you see Grant Cardone commercials on TV, right? And they'll talk about 2x multiple or whatever, so this is like a 2.1x multiple on whatever you put in. So you get what you put in back plus, in this case, 275, which results in these percentages. And like I said, these change like all the time. I mean, we're hoping they change as they go down because we go in our underwriting and we get our insurance quote. It's less than $1,300. We get our payroll worked out and it's less than $294. Then it changes all this stuff. Hopefully to the good. We won't hit every one of them good, but we're pretty conservative. So we normally hit them to the good. Knock on wood. I shouldn't even say that out loud. Sources and uses of cash. So we've got, the total that we are going to use is $22,686. We've got our small CapEx budget that we talked about. We got our purchase price, other closing costs and escrows of 1.18 million. Total sources to make up that number, these match. The loan amount of 14.875, and then we need to raise 7.811, 7.7. It just depends on how these, that's a small difference, just how it shakes out with the closing costs and things. So down payment, closing costs, there's your acquisition fee we talked about, capital budget, capital reserves, and then the total equity uses. So that's all the money. That's what we're going to use it all for. That's the plan. If we go in and it doesn't cost us as much to buy it, this happened on the one that Nicole's involved in Gastonia. 2 things happened there. number one, we didn't have to raise as much as we thought, so we cut it off early. Once we got to where we felt comfortable with, we said, all right, we don't need any more. And number two, we had a pot of cash left in the bank. And so now we're very comfortable in our situation. We know that on this first year, as we're bringing everything up to speed, doing our lender required repairs, we got a nest egg that once we're finished being comfortable with it, we will give it back. And that's just a good feeling to be in. You know, then I don't have to call back and say, hey, Nicole, could I have another, I need another investment, which capital calls happen. I mean, you know, if y'all have been in this business, maybe you've experienced it, where the GP calls you and says, all right, we're $1 million shy, $1 million divided by however many you are is what we need. We try to avoid that. I think would be an uncomfortable call to make personally. I've never had to do it, so I don't want to do it. There's the pictures. You know, we've got amenities, we got a swimming pool, a workout room, an office, we got dog parks, playgrounds, storage units that we can rent out on top of for extra income. We've got laundry facilities, coin operated for other income. We charge fees for, you know, technology fee, for pest control fee, trash fee. We get reimbursed for all these things in our operations.
Any of the units have connections that they try to experiment with?
Yes, so yes, 86 or 82.
Washer dryer connections?
We're short, 82 of the units don't have connections.
That's part of our CapEx budget.
The rest of them have connections,
Yeah.
and some of those have washer and dryers. But they charge for all of that. So you get more rent if we put you a washer and dryer.
So your overall condition of the property is good? Are you happy?
Yes, I mean, we're gonna go up and fine tooth comb on Monday, but yes, the overall condition is good. The roofs are, how many roofs are?
So 28 of the 31 roofs are under 10 years old, which is great for us.
Yeah. So we're good. And I told that to one of the insurance guys today and he loved it. So that's a good thing for us. So, you know, if we're projecting a 5-year hold, unless there's some storm or something that happens theoretically covered by insurance, yes, we'll have to pay deductible, but we should not have to have roof replacement expenses the whole time we own it. So that's good because roofs are expensive. HVAC, yeah, we'll have HVACs. We just fix them as they go. Sorry. You were going to ask HVACs? Yeah. Yeah, those are expensive, roofs and HVACs. This is the storage units, by the way. There's a little section of the property. You'll never see this, but it's right here. And they've got these 3 buildings that are just like self-storage type metal structures with roll-up doors, and they lease them out, which is fabulous. And so now I'm looking around where on this, there's a lot bigger empty spaces than that. I'm like, how many more of those can we throw in?
That's under other income?
Yeah, yeah, we'll find out. Because if they'll let us do it, we're gonna try to figure that out.
Building additional ones is not built in today. That's something that
Oh yeah,
we'll
we didn't
explore.
build that at all. Yeah, that's total gravy.
But when
Build
you-
them, that's right.
Yeah, exactly. When you drive into the property, you've got 2 different styles. You've got 96 garden units off to the left, and then on the right-hand
That's
side.
the style,
Yep, that's the style right here. And then on the right-hand side, you've got 100 townhomes.
right, which is right here. Alex used to live in them, didn't you, Alex? Swimming pool, I told you about that, workout room, picnic tables, grills, sorry. And then the rest of this stuff is not filler, but it's educating you on Jacksonville and things like that if you didn't know it. That's the rest of the presentation. Again, this was emailed, I think, to all of you. If you didn't get it, let me know, I'll email it. If you're the kind of person that likes spreadsheets and likes to have numbers and dig in, let me know, we'll dig in.
We can talk for hours.
Yeah, it's our favorite thing to talk about. So that would be fine. We would, so this is a big raise, right? For us, it's all relative. It's for some, it's not that big of a deal, but 7.8 million. You know, we would love to have our starting investments at 250,000. We realize that some people can't do that. We realize that some people have never done business with us. and would rather start with a smaller investment. So we're prepared to take the smaller investments and be grateful for them. If you are so inclined to want to talk about 250 or more, we would be happy to talk about that too, obviously. If you know anybody that's not here that you think might benefit from this, I personally think everyone would benefit from this. But if you know someone, please pass our name out and set up the call. And let me see if I can do one thing.
Ashley, do
Go ahead.
you want to talk about the capital you have in the deal? Just to let everyone know the skin we have in the game?
Yeah, Allison, you want to tell them? No. I'm just- Don't act like you've forgotten. So
I think it's important to know that there's a significant chunk of change
question.
invested by the GPs, because if you invest with somebody who has no skin in the game,
Yeah.
I don't have much to lose. We have quite a bit to lose, and we're putting a reputation on the line,
Yeah.
and it's because we think we can do it.
I'll just tell you, so part of the negotiation with the seller was that we had to increase our earnest money deposits and non-refundable money. So I started low, as you might expect, and they're like, yeah, we like all this stuff, except you're gonna have to really beef this up. So end result is I wrote a check for $210,000. Right off the bat, $100,000 is non-refundable. So it's gone whether we do close the deal or not. At the end of 30 days, the other $110,000 is non-refundable unless, I get no benefit from it unless we close the deal. And so one of the things on our call was, I said, look, let me tell you something. $210,000 means a whole lot more to me than most of the people you guys probably do business with. I said, if I write this check, I will promise you that this deal will close. So I will find a way to make this deal close. I wouldn't have taken that much money of our own and put into this if I didn't believe that it was a good investment. And it's going to make people a lot of money, including us, hopefully. That's the idea. So end result is I'll have $250,000 in this with you or whoever decides to participate.
And we're writing a check for $30,000 for the loan application on
Yeah.
Friday.
That's right. So 280,000.
There you
go. I won't spend much time on this, and you probably can't see it anyway, but what this is a cost segregation study. And the idea here is that one of the benefits of owning real estate is that you get to depreciate it. And so you can make money, you can make cash and get paid and pay no tax because you have a taxable loss. And so when you have a property like this, you get a cost segregation study done. The IRS says that if you don't do the cost segregation study, the straight line depreciation is 27.5 years. So you take the building value and then like the value of those storage buildings or whatever, street lights, and then you just divide it by 27.5 years. And that's what you get to take every year as a reduction of your taxable income. So the cost segregation study, they literally go in and count every light switch and every toilet and every water faucet and like all that minute of detail. And all of these things have different usable lives. So some are 5-year property, some are 7-year property, some are 15-year property. And so the ones that actually have a shorter life, you get to depreciate faster. So you get more of the depreciation up front. And then on top of that, you have the ability to use bonus depreciation, where you can bring, what is it now?
60%.
60? It's going down every year. But I think it's 60. Anyway, so we bring that forward into year one. Well, obviously in year one, we're not going to make hardly any money. So because of the timing of it, but even if we did, it wouldn't be even close to the depreciation loss that we can take. So end result, and please consult your tax professional because I'm the farthest thing from that. But end result, to think of it simply, there's a really large chance that we will get paid cash out of this deal and not have to pay any tax for at least 3 years, maybe 5 years. Now, you will get a K-1 and you will take that K-1 to your tax professional and they'll do your taxes. So you may have lots of these types of investments where you have other passive income and you can use it to offset that taxable income. You may not, and if you don't, then the only thing you can use it on is passive income. So you just hold it and just basically you just take money from this deal at no tax each year. If you're a real estate professional like we are, you know, all of our income, Lynn, is thrown into one basket. So we can use this to offset, like if we sell a house and make a commission, it offsets that income also. But again, this is different for every single person. Yes, there's depreciation recapture, but it's usually at 25%. And if you're at a 37% tax bracket, you just made the spread on that too. But you gotta ask your person on that. That's calculating that for other people is definitely over my head. Yeah, I remember you were pleased with that. Yeah. Yeah, and Nicole can use that against her ordinary income as well. So that, I remember that day, actually, you you saw me in the parking lot. Yeah, that was good. So that's it. I think, Michael, is anything that we forgot to talk about?
No, just is everything, is it clear to everyone, the returns that we're estimating, how it's calculated? Does anybody have questions that they want us to elaborate on? We were just that clear.
Yeah,
Great.
I doubt that.
Great.
You sent this out to us, I hadn't seen it yet.
Yes, and if you
it's
don't,
out.
but yeah, we'll get a copy. Yeah, for sure. I'll write it down right here.
Just thinking about obligations for improvements, I didn't see any ADA improvements out there. Looked like the swimming pool doesn't have access. What's the obligation?
I can't answer that. That's part of what we think we're gonna find out on Monday. Right now, there are no deficiencies that we're aware of. That was part of our due diligence. They had to declare to us that if there were any code violations or deficiencies, we haven't seen anything like that they've declared. They've been very, very upfront, quick to respond. It seems to be run in a very thorough way. We've been pleased, right?
Yes.
The last one that we bought was like, Lord have mercy, it wasn't even close. So we had to dig through all this mess to make sense of it. This is a different ballgame.
But the full physical inspection on Monday,
Yeah.
we walk all units.
Plus, rest assured, this being a Freddie Mac loan, they will hire, and they hire their own inspector, and it has to meet all of the government regulations. And then they put that in there as a requirement. We have to escrow certain amounts of money to fix these things. So if there is anything like that, it'll be addressed. They'll find it for sure. Yeah, so this fund is just like a 5-year fund, just like this. And, you know, picture it like this, just on a massive scale. I don't know how many properties they had in this fund, but it's just time to turn it over. So just like you, and you know, it's Alex Rodriguez says, okay, we got to sell it because Bobby needs his money back. And that's just what's happening. Yeah. It's just a timing thing.
Bobby needs a new boat.
Bobby needs a new boat. You got to pay. That's right.
The deck you sent the other day is up to date with pro forma numbers. Other than you said there were two slightly different.
Well, we did, no, we did, yes. So the ones, yes, it's up to date. This, what you're looking at is the same as this, same PDF. The numbers were changed before I put them into that PDF on the insurance and the payroll. But we have not changed anything since then, like the interest rates, none of that's changed. Yeah, so I'd like to have all the money in the bank by September 15th. We've got, I'd love to have it in the bank by the end of August, but I know that's not going to happen. The end of August is the end of our due diligence period, at which that other 110,000 becomes non-refundable. So I'd love to have it in the bank all before then, knowing that's not going to happen. But just to get the transaction done by the end of September, we'd like to have it by middle of September. We do have the option to extend the closing an additional 30 days, but I have to put another $100,000 non-refundable deposit to get that. It goes towards the purchase price, but at that point they're like, yeah, we'll give it to you, but we want to make sure you're really tied in. So if we need it, we'll do it. Hopefully we don't. commitments today? To date. Oh, I thought you were gonna like, before, pass the hat. Sure, we'll take commitments today. Commitments today, probably $1 million. And again, they're soft commitments because we don't have bank accounts set up yet. We filed the LLCs and operating agreements. We actually reviewed this afternoon. So we've got to get all that done, and it'll probably be by the end of this week, and we'll have bank accounts set up. And then we can start really, after we get all the SEC docs, the PPM, the offering memorandum, all of those things, once we upload those to our portal, then you would log in and create your investment profile in our portal. Then you go through, all of the documents would be in there for electronic signature. Of course, you can print them and review them, have attorneys review them, all that stuff. Once that's done and signed, then it allows you to wire the money directly in the portal into the general partnership account. So we're probably 10 days from being able to do that, is my guess. What you could do now, and what we hope people will do, is log into the portal, create your profile, and then do a soft commitment at this point. That way we kind of know what we're doing, where we stand, how much more we need to raise, et cetera. And then the portal just walks you through it. So if it was soft investment, and then it would become a hard commitment, and then it would become a fully funded investment.
Where are the terms and conditions for the partnership agreement? Is it in the portal, or like the agreement we would sign with you?
Yeah. So that would be, yeah. So what would be the full operating agreement for the general partnership LLC? And yes, the whole thing will be in there. Plus the private placement memorandum and the offering, I just got tongue tied. The offering memorandum, sorry.
Operating agreement?
Well, and the operating agreement, but so the operating agreement is the governing document for the LLC, which would own the asset. That's the kind of thing that tells like how you vote out the general partner, how you change this in the event of a default, in the event of a death of a limited partner or general partner, or if you wanted to sell your share, it spells out very, very, very detailed, exactly all of that.
Yeah.
So if you guys have any like estate planning concerns, which you probably all should, you need to read that and understand what happens. Where does this go if I die? Who gets it? If I decide I need cash more than I need to be invested in apartments, how do you get cash out of here? There's specific ways it has to happen, but it's all in there. Okay. Yeah. Very, very detailed. And we've used this attorney before. It's the one that Nicole had, and I know she read every word of it. But yeah, it's very good. Very good. We need more drinks. I was hoping Evan would be over here with refills. What else? I actually meant to have up the portal. I don't know if I can endeavor to pull that off in front of everybody.
Actually, if we don't have access to the portal, how do we get that?
Yeah, so I would need to email you a link, and it's this portal. It's a very wonderful system. In fact, the CPA loves it also because the distributions are calculated automatically. Once you put your account information in here, you fund it through here, but you can also then receive your distribution right through here, the K1, all the documents, everything's there, and it's really, really fabulous. This is my side of it. Copy link. I think I can come up here now and show you this. Oh. So when you get the link and when you click it, this is what you'll see. And up here in this, the top corner, it says soft commit. When we get to the point where we're able to actually accept money because we've got these documents, then it will be a hard commitment or create your investment. It changes depending on how right now, the only thing we can do is a soft commit. So you would click that and then you would, just follow the prompts. It tells you exactly what to do. Profile, I'm gonna be a test investor, or I'm gonna invest and create new profile. If you're not in here, that's what you would do. Yeah, good. Thank you.
And do you do it just as an individual, or if you already have an LLC, can you do it as the LLC?
Yeah, so we've had people do both. We have some investors that are individuals. We have some investors who are LLCs. But yes, it just depends on your own strategy, I think, your own planning. But we can manage either one.
We've got
Oh, yeah, more drinks, glass of wine.
I think you've done a banging job on, being thorough and a great presentation.
Thank you. Thank you, thank you. Well, if you think of questions on the way out or tomorrow, just text me, call me. And we'll have coffee if we need to, or we'll do it on the phone or Zoom or whatever. And spread the word. We need, you saw what we need to raise, and it's a good opportunity. I mean, I really think like I said, I'd love for the minimum to be 250, but there are people that I want to have involved in this because I think that it helps everybody achieve that goal that I want badly for me and my family. And I know other people want the same goal also, and this is a way to get to it. If you're already to that point, then this is a safe place to put your money, because in 5 years, it's going to be here, and it's going to be probably more than what you put in it. So it just depends on your perspective. That's all I got. That's all we've got. I appreciate you guys coming.